After he started his hedge fund back in 1985, over the following 10 years, Joel Greenblatt realized an average annual return of 50%. Let's find out where he's invested today. Hey there. For those of you who don't know me, my name is Steven Spicer, and it's my goal to help you invest smarter. And one of the best ways to do that is by learning from the investment greats. And one of my favorites is Joel Greenblatt. I'm going to give you a brief history of this legendary investor so that you know why you should listen. Then we'll look at what he's doing today and why that's different from before. And finally, we'll explore his top 15 holdings and one short to hopefully give you some ideas for your next deep dive. Now, if you followed me for any amount of time, you know that I'm a fan of Mr. Greenblatt. His style resonates with me, and I can't help but learn a lot every time I hear him speak. In fact, earlier this week, I released a video walking you through his brilliant metaphor, comparing the stock market to a jar of jelly beans. And if you haven't seen that one yet, you should check it out. I'll link to it in the description. I'll also link to one of my most popular videos, one I released about a year ago, diving into Greenblatt's top 5 lessons. And each of those lessons is critical for an active value investor's long-term success. The reason I particularly like listening to and learning from him is because he found opportunities in places and through means that are accessible for you and me as well. What I mean by that is he wasn't using any out-of-reach technologies or proprietary algorithms to find these gems with insane upside potential. And he was primarily, at least in the beginning of his career, investing in smaller companies, which is an area of the investment world where the smaller investor will always have the advantage. I talked about this concept ad nauseum in a video I did for Ryan Scribner's channel a while back. I already mentioned that from 1985 through 1995, Greenblatt's fund averaged 50% per year. That's impressive. So you might ask, why did he close down the fund if things were going so well? That's a great question. And the answer is a brilliant nod to the treasure trove that is the world of smaller cap, lesser covered stocks. He and his main partner, Robert Goldstein, noted that above a certain threshold, it would be harder for them to realize the kinds of returns that they had been. That's because they'd be too large to make meaningful investments in these smaller, clearly undervalued companies. So they capped their fund's size at $500 million. And for a while, they were just returning the gains in excess of that figure to the partners, until in 1995, when they had enough themselves and decided to just kick everyone else out. They returned all the capital to their partners, they closed down the fund, and managed it, just the two of them, for the next decade. Since it was totally private between the two of them, there isn't a public reporting of their year-by-year returns like they had for the first decade. But in an interview with the Wall Street Journal, Greenblatt revealed that the annualized return over that 2-decade period, from 1985 through 2005, was around 40%. Again, that's beyond impressive to achieve those high return levels consistently for 20 years. That definitely qualifies him as a proven skilled value investor from whom we all should learn as much as we can. Now, if you're interested in learning directly from him, he's written several interesting and witty books. As to which one I'd recommend you start with, well, that depends on you and where you're at. So because I get asked about the best investment books a lot, I thoughtfully put together a page that highlights all of my favorites, whether you're just beginning or already a pro looking to expand your knowledge further. I included thoughtful commentary to help you know which of the many would be most appropriate for you based on your interest and existing knowledge. And you'll see what I mean when you get there. The link is in the description, and you might want to bookmark it for whenever you're looking for your next read. I sincerely hope it helps guide you to your next investment breakthrough, and I hope you'll tell me about it whenever you get there. So for me, Greenblatt's record puts him right up there in that exclusive investment legend club that includes Peter Lynch with his 13-year, 29% record, and Warren Buffett with his 50-plus year, 20% record. There's so much to learn from all these guys. In this video, specifically, we're going to look at what Greenblatt is doing today. After closing down his fund in 2005, he started focusing more on his philanthropy. He also has written several books since that time, and he began researching strategies that could be applied successfully on a broader scale, not just for relatively smaller funds able to dabble in small caps like he had been. Today, he manages long-short mutual funds, so they're available to most investors. And more importantly, they're investing more than $6 billion now. quite a bit more than that 500 million at which they'd capped themselves before. So keep that in mind as we go through this list of holdings. They're different than before. This is a broader, more mass appeal. Due to his size, some of the opportunities that he might have pounced upon in the past would not be a meaningful option for him today. So if you're trying to invest like he used to, like he details in You Can Be a Stock Market Genius, like I often invest, like I've covered in past videos, I'll link to those in the description as well, the ones I'm about to run through won't be those opportunities. But if you're looking for value opportunities hidden in the world of large cap stocks, like solid S&P 500 companies, then these might be a good place for you to start your research. And that's why I'm doing this. So I'm gonna share with you his top 15 holdings as of its last reporting. And then I'm also gonna share with you one short that he disclosed recently in a CNBC interview that I found interesting, and I think you might as well. All right, so as I read through this list of 15, I think it'd be most prudent if you're looking for large cap stocks that Greenblatt has identified as being undervalued, for you to pay special attention to the ones with a smaller market valuation. Think about it, this fund, as of its last reporting, holds 965 stocks. So it makes sense that some of the largest companies in the world will show up in his top 15 holdings. You know what I mean? I mean, for example, I'd expect Apple, if he owns it, to represent a decent percentage of his portfolio relative to the others, because it's just so big. Same with Amazon and Alphabet. But when you see other companies that are 8 or 30 times smaller than Apple, representing a similar allocation weighting in his portfolio, those are the ones that I'm most interested to dig into. Now, since I'm about to talk about individual stocks, I do have to say that I'm also a practicing registered investment advisor. So it's important to me that you understand that these are not recommendations in any way. I don't know your particular circumstances. I'm just going to point out some facts about these companies and tell you why they're interesting to me right now. And if they seem interesting to you, you should definitely conduct your own research and analysis to decide if they make sense for you and your unique situation. My goal with these videos is to help you identify different aspects of the research process and expose you to some different ideas, so that if something piques your interest, it can be a good starting place for your own deep dive. With that in mind, here's that list. At the top of the list is Honeywell International, ticker HON, with a market capitalization of $122 billion. That's one I pay attention to. Second is Verizon Communications, ticker VZ, at $235 billion. Then you have Apple, AAPL, at $964 billion. Then Altria Group, MO, $103 billion. And number 5 is PayPal Holdings, PYPL, at $126 billion. Number 6 is International Business Machines, IBM, at $124 billion. Next we have Amazon and Alphabet, tickers AMZN and GOOGL, both around $900 billion. And number 9 is United Technologies, ticker UTX, a $122 billion company. Next you have Walmart, WMT, a $294 billion company. And then you have a smaller one, Micron Technologies, ticker MU, a $48 billion company. Next you have Raytheon, RTN, a $52 billion company. At number 13, you have Lockheed Martin, LMT, a $92 billion company. Then you have Procter & Gamble, PG, a $257 billion company. And then, the smallest of this list of 15, HP Inc., ticker HPQ, a $30 billion company. So again, I pay special attention to those smaller companies that somehow made it into Greenblatt's top 1.5% of all his 965 stocks. And honestly, you could just continue down that list and find some pretty small companies weighted relatively heavily in his fund. I'll link you to an updating list in case you want to use that trick on your own for your own discovery process as you search for the next stock that you want to dive into. One last stock I want to share with you is the company Greenblatt mentioned as one of his favorite shorts right now. Now remember, this is a long short fund. They're long a lot of stocks and they're short a lot of stocks, well diversified on each side. The idea being that this will best position them come what may, a lingering bull or a devastating bear. But there are definitely some risks involved with shorting, so don't just go out and bet it all on this one short, or any for that matter. That would be ill-advised. Understand what you're doing first. We can cover the details of shorting in another video if you're interested. But with that in mind, the particular stock that he mentioned is Align Technologies, ticker ALGN. It's the $23 billion maker of Invisalign, you know, the clear braces alternative. Well, he says that the company is trading at extremely elevated multiples. As a simplistic example of this, the company's PE ratio is 58 as of this recording, whereas the industry's is 39 and the market is only 18. Its PB ratio is 19 compared to the industry's 4 and the market's 2. That's the price to book ratio and the price to earnings ratio. His main case seemed to be that they don't deserve these multiples anymore, as most of their patents are coming up. I know, I for one, at least have seen a lot of knockoff commercials for invisible braces at a fraction of the cost now. I know when I glanced at it, I noticed a pretty steady stream of insider selling over this last year. I definitely wouldn't want to be long right now. I'm interested in diving deeper to see if a short position would make sense for me. Now, they don't have any debt and they do have a lot of cash sitting around. So for me, that'll weaken the case for a short, but I guess we'll see. What do you think? Which of these companies are you most interested in exploring more? I hope this information has given you some ideas for what you could research next. I've got some more coming your way, so I hope you'll subscribe and click that notification bell to join us on this journey. I can't wait to catch you in the comments. I sincerely do wish you all the best. Take care.